secret signals, and magic market bells. I get asked a lot about how to know the best time to buy or sell stocks. People are always looking for a secret signal, a magic bell that rings at the very top and bottom of the market. They hear about these tools with funny names and think they'd finally found the answer. But today, I want to tell you why that's not just a fool's game, but a dangerous one. It's like trying to read a compass to predict next week's weather. I want to share with you the story of 3 useful tools that most people use completely wrong. And to understand why they're wrong, we need to understand what these tools actually measure. Let me introduce you to our 3 characters. First, there's what we call the PE ratio. Now, this is probably the simplest of the 3. Think of it as a price tag. It's just a simple calculation, how many dollars you're being asked to pay for each single dollar of a company's yearly profit. If you're paying 25 for 1 of profit, that's a higher price tag than paying 15 for that same dollar. It's a wonderful, simple way to compare 2 similar companies standing side by side on the shelf. Then we have the Shiller-Cape ratio. This is like the long-term weather report. You see, the problem with our first tool, the simple PE ratio, is that it only looks at last year's profits. But what if last year was unusually good or unusually bad? That would give you a distorted picture. So Professor Shiller, a very smart friend of mine, said, "Why don't we smooth this out?" His ratio looks at the average profits over the last 10 years. This helps account for both the really sunny years and the stormy ones. It tells you whether we're in a generally warm climate or a cold one, rather than just what today's temperature is. And finally, there's what people call the Buffett indicator. Now, this one is different. It's not looking at individual companies at all. It's like a scale for the whole country. On one side of the scale, you put the total value of every single publicly traded company in the stock market. On the other side, you put the size of our country's entire economy, what we call the gross domestic product. If the stock market side gets much heavier than the economy side, the scale tips and tells us that things might be getting overpriced relative to the actual output of the country. Now, here comes the most important part of our story today, the part that most people get completely wrong. All 3 of these tools are wonderful at telling you what is. They are absolutely terrible at telling you what will happen next. Let me make that even clearer. They are magnificent at describing the current landscape, but they are utterly useless at predicting when that landscape will change. Let's think about this with an example everyone can understand. Imagine you have the world's most accurate thermometer. You look at it and it reads 95 degrees Fahrenheit. That's undeniably, unequivocally a hot day. Now here's the crucial question. Does that magnificent thermometer tell you that a thunderstorm will arrive to cool things off in exactly 1 hour? Does it tell you that this heat wave will break tomorrow? Or does it tell you that it might actually get even hotter next week? Of course not. The storm might come this afternoon. It might not come for 3 more weeks. The sun might keep beating down, and the temperature might actually climb to 100 degrees and stay there for a month. The thermometer is perfect at its job, measuring the current temperature, but it tells you nothing about future weather patterns. The stock market works exactly the same way. A high PE ratio, a high Shiller-Cape, or a tipping Buffett indicator is exactly like that 95-degree reading. It tells you the market is hot. It tells you that investors are paying premium prices for stocks. It tells you that caution is warranted. But it does not tell you to sell everything you own and run for the hills tomorrow morning. Why not? Because hot markets can stay hot for years. The enthusiasm of investors can be like a wind that keeps pushing prices higher and higher, even from what seems like an already high starting point. If you sell all your stocks just because these indicators look expensive, you might miss 2, 3, or even 5 more years of substantial gains. You would be like a farmer who refused to plant any seeds all summer because the thermometer said it was hot. You'd be right about the temperature, but you'd have a very hungry winter. I've seen this happen time and time again. I've watched brilliant people sit on the sidelines for years waiting for a correction that took much longer to arrive than they ever imagined. They were right that valuations were high, but they were terribly wrong about their timing, and in the process they missed one of the most powerful wealth-building opportunities, the simple act of staying invested. Now, let's look at the other side of the coin. When these tools show that the market is cold or cheap, it doesn't mean it will suddenly spring back to life tomorrow. The market can stay pessimistic for what feels like an eternity. Stocks can remain cheap for months or even years while everyone worries about the economy. But history has shown us that these periods of pessimism are often the very best times to be planting your seeds for the future. So if we shouldn't use these tools for timing the market, what in the world are they good for? Their true value lies in providing context and discipline. Think of them as your compass rather than your crystal ball. A good compass tells you what direction you're heading, north, south, east, or west. These ratios tell you what kind of environment you're investing in, expensive or cheap, risky or relatively safe. That is incredibly valuable information for setting your long-term expectations and strategy. But a compass cannot tell you about the swamp you'll have to cross tomorrow or the beautiful meadow you'll discover next week. Only the actual journey, only time itself, will reveal those things. Don't fall into the trap of trying to use your compass to predict the swamp. Instead, use it to make sure your overall direction is sound. If you know you're in expensive territory, you shouldn't be reckless. You should be careful and disciplined. You might choose to save more cash, avoid taking on debt to buy stocks, and make sure your portfolio is properly diversified for rougher weather. But you don't abandon the journey altogether. You don't sell your farm because you see a hot day on the thermometer. The greatest investors I've known aren't the ones who perfectly timed every little up and down in the market. They're the ones who understood the climate, planted good seeds in good soil, and had the patience and temperament to wait for the harvest, through sunshine and storm alike. They understood that trying to time the market using these indicators is like trying to time the seasons. You might know that summer can't last forever, but you'd be a fool to try to predict the exact day fall will arrive. So what's the practical lesson for all of this? First, learn what these tools actually measure. Understand that the PPE ratio is your price tag, the Shiller Cape is your long-term weather report, and the Buffett indicator is your national scale. Second, use them for what they're good for, understanding the environment you're investing in and setting your expectations accordingly. If valuations are high, expect lower returns in the future. If they're low, the potential for higher returns may be better. Third, and most importantly, never ever use them as a timing device. The market can remain expensive far longer than you can remain solvent on the sidelines. Remember, a thermometer measures the temperature. It doesn't change the temperature, and it certainly doesn't tell you when the seasons will shift. Your job as an investor isn't to predict the weather, but to pack the right clothes for a long journey and to keep walking forward, no matter whether the sun is shining or the rain is falling. The disciplined investor, the one who understands the difference between a compass and a crystal ball, is the one who builds wealth that lasts. Everyone else is just guessing about tomorrow's weather.